Hi, Steve here. Welcome to your next edition of Highlights, your special video newsletter. And today we're going to be talking about one of the legs of the trading triad. For those who are familiar with my trading triad success system, you know that candles are just one part of the system. You know, the candlestick charts are great for early reversals if you know how to use them correctly. Great for early reversals, great for helping us avoid bad trades. And really, the main focus of the candles, the main attribute, is letting you spot those early reversal signals very often before the market makes a big move. But we know that, or we should know, that it's only part of our trading system or analytical system, the trading triad. The second leg is Western charting techniques, and that's because, as you have probably gathered by all my educational resources, it's very important for a candlestick signal to confirm a Western signal. You know, I have my favorite Western tools. You probably have your favorite Western tools as well. But what we're going to be looking at in this section, session today, is an aspect about trade management. And this is truly something that separates those who use candles correctly and not correctly. And one of the things that I want to bring out is the importance of stops. I'm going to look at that in a minute or two. Now, many of you are familiar with Warren Buffett, and he has a couple of rules, and some of you may have seen this before about money management. 1, don't lose money. And rule 2 of his 2 rules is don't forget rule number 1. So, when you use candles, some of the candle signals, not all of them, but many of them can be used as protective stops. And protective stops are really, really important. The Japanese have a great proverb. It says to get a prescription after the funeral is over. And to me, trading without using a protective stop is really trading very, very dangerously. So let me go through the idea of a protective stop using something as basic as a hammer. Now, the hammer, basic candlestick signal, long lower shadow, twice the height of the real body. Real body can be black or white. Little or no upper shadow, and the low of the hammer should be a potential support area. So if you're buying on the hammer, you must be willing to risk to under the low of the hammer. So let's look at a case in point. Now here we have a lot of information, a lot of graphics. So let's go through this. First of all, you see this blue arrow here that I'm highlighting the black real body wrapping around the white real body. Isn't that a bearish engulfing pattern? Well, the answer to that is no. And I want to give you a minute or two to think about why that is not a bearish engulfing pattern. Remember, a bearish engulfing pattern is when a black candle wraps around a white candle. The answer is the trend is wrong. A bearish engulfing pattern must come during a rally, not during a sell-off. Again, you know, there are lots of nuances to candles. Many of those who learn candles elsewhere or have not gotten my educational resources are not aware of. And imagine selling, thinking there's a bearish engulfing pattern, only to have this stock rally $6 in a few weeks. So this is not a bearish engulfing pattern. Now, anybody recognize this candlestick signal? It's a 3 candlestick signal, long black real body, small real body, not touching the first real body, and then a long white candle that gets deeply into the black real body. That's a morning star. It's a bottom reversal signal. So why I'm pointing this out is because look at the arrow here just a couple of weeks ago. Okay, that's a classic hammer. It's okay to have a little bit of an upper shadow. And what's interesting is that hammer is confirming a support area set at the low of the morning star and also from the lows this year back in January. So we have a lot of positive potential here as far as the hammer working out well. It's confirming a support area set by Morningstar in March, by the lows in January. So the hammer is confirming support, and to me, my first resistance would be change of polarity. Those are the horizontal lines that showed up. Again, and this is my basic educational DVDs. Essentially old support. I should have made this line a little higher. But essentially old support, the support zone. Once the market breaks under, it becomes resistance. And notice that's exactly what happened here. So if you're thinking of buying the hammer, you have a lot going in your favor here. As I mentioned before, it's confirming support, a very attractive risk-reward. So what I'm going to do now is do what I do at my live seminars. or my private coaching where I go candle by candle. So let's look at this. So the next session, see the hammer over here? Now we have a black wrapping around a white again, but remember, over here, black wrapping around white, but that's not a bearish engulfing pattern because the trend is down. Remember that same situation we had over here. So let me bring out something important. If you were in this hammer, if you were long from this hammer, would you still be long here in spite of the lower close? And the answer should be yes. One of the misuses of candles is people think you get a hammer, the next day the market rallies. That is exactly wrong. Okay, if you're buying on the hammer, you must be willing to risk to under the low of the hammer to say that you're wrong. So we would still be in the long position here. Now let's go just a couple more days here. Now notice something interesting. The hammer is still holding as support, below the hammer, but now we're getting a resistance area. So one of the things I bring out in my trade management seminars is what I call market chameleon, adapting to changing market circumstances. So you might be long on the hammer, but looking at this resistance area over here and over here, you may say, well, the low of the hammer is holding as support, but the market is stalling here, so maybe I'll scale back on long positions. And nothing wrong with doing that. But as far as still being long, the answer to that is yes, because the low of the hammer is still holding. So we progress another couple of sessions, and notice how that resistance area is still in place. So it's a real battle going on here between the support of the hammer and the short-term resistance area. So again, with the failure of the resistance, on the most recent action here, shown on the slide here, we may scale back and maybe have even less of a long position. Now, there's something also I don't have time to get into here, but there's something called time stops. In other words, if you're buying or selling based on a candlestick signal, you should give a certain amount of time. And again, that's beyond the scope of the session here, before saying it doesn't work out. So you may be looking at something like this and say, hey, the market's just meandering. I expected it to rally. It's been trading sideways for 5 days. Maybe I'll just bail out of the whole position or most of the position. Anyway, the lower the hammer is still holding as support. And this is where everything changed. See, as soon as the market gets under the hammer, okay, either intraday or if you want to wait for a close, it would be down here. But intraday, everything had changed. So once the market broke under the hammer, if you were long, you were wrong. And that's one of the great things about stops, is always a price that says you're wrong. And this lets you stay in the game, protective stops. It's fine to take small losses. It's when you let the losses run and run and run that the traders get blown out of the water. Okay, I deal with institutional traders, and they always use protective stops because for them it's better to take a lot of small losses so they have trading capital to get the high probability trades. And remember, okay, the race is not always to the swiftest, but those who keep running. As the Japanese would say, as the Japanese would say, 7 falls and 8 rises. Hope this helped, and may the candles continue lighting a path to greater profits.